5 mistakes investors make when buying rental property. As a seasoned tax expert with 4 decades of experience in taxation and as a residential real estate investor with 3 decades of very successful investing, I would like to share with you some valuable insights in how investors who are buying residential rental properties make very costly mistakes when they purchase a rental property. Inadequate financial analysis on the subject property, improper entity structure, organizational structure, failure to properly model all tax attributes of the property, failure to identify recognized profits versus tax profits, failure to analyze income, costs, profits on a square foot basis. Let's dive into each of these for a short review and see if any of them sound familiar to someone you may know. Mistake number 1. Financial analysis on the subject property is critical, yet so often some of the most important information is overlooked or disregarded. How are you verifying from the seller all of the income and expenses on the property? I trust you are looking at the books and records and the tax returns in order to match the information with what is being offered as data. Understanding fluctuations month over month and year over year can tell you a great deal about hidden issues you may not be seeing. No financial fact or data point is too small or insignificant that it does not matter. It all matters at the end of escrow. We employ a very detailed financial disclosure request that is extensive in vetting the data and verifying it across multiple sources such as owner's tax returns. Mistake number 2. How you invest in real estate will decide how you get taxed and how you will make a profit or suffer a loss. Entity organizational planning for a deal is critical if you ever hope or desire to win the financial game of profits. Finding effective ways to utilize closely held corporations as management enterprises and limited liability companies that are member-managed with you and your corporation as part of the LLC, for example, give rise to very powerful financial and tax strategies that can equal or exceed your profits and gains. Every deal should be vetted through this lens before you close escrow. Mistake number 3. By not creating a financial model to illustrate in financial terms the transaction and all of its varied tax and financial attributes, investors seriously diminish the true value of a property and fail to unlock its full financial potential. The tax attributes are akin to money in the bank, in that as you harvest these tax attributes and organize them to be efficient in providing you added ROI, the real cost of the property becomes significantly lower than the actual price you pay or agree to pay. The challenge is far too many tax professionals lack the skills to take a client through this exercise, and fewer yet investors would even understand how the process is completed. At the end of a deal, it is costly to be sure. Mistake number 4. Understanding the distinction between recognized profits versus tax profits is critical. The ability to know this difference and how it is calculated leaves the investor at a serious disadvantage financially. Couple this with the other mistakes, and soon the deal, while good on the surface, will never be the great deal it should be, but for the lack of knowledge and understanding that lost so much money on every deal. Mistake number 5. Having the ability to fully analyze the income, expenses, costs, profits, and apply this using a square foot rentable space format basis give you the investor a decided edge in every deal. Fully reviewing the financial data and the totality of the income and expenses is so fundamental one would think it obvious. Yet too often little or no attention is paid to the data that drives the real profits in every deal. As an example, using a fourplex you have a potential to purchase. It is 4 units each with 100% rentable time of 365 days in a year. So we go into the actual income records and break down the income on a 365-day year, and then look at the total days of no rent to properly determine our true vacancy rate, along with understanding that rentable scoffed is the metric to measure. There you have it, 5 mistakes you can now avoid as you grow your real estate portfolio. As always, ITWS Financial Services is here to guide and support you. Reach out to us at the contact information below.